Hello everyone and welcome again to my How To Education channel. As I promised you last week, today we're gonna continue with the second part of How to Ace Finance, Financial Statements, Taxes and Cash Flow. After watching this video, don't forget to leave me your feedback. After going over the balance sheet and the income statement last week, today we're gonna speak about the statement of cash flow. A statement of cash flow is another important financial statement that gives a clear picture to the financial manager of all the cash flowing in and out of the company. The cash flow of a company, which means the amount of cash that the company can use, is equal to the difference between the cash inflow, which is the cash entering the company, and the cash outflow, which is the cash used to make payments. So cash flow equals cash inflow minus cash outflow. The cash flow coming from assets must be used to pay the creditors and the stockholders. Thus, cash flow from assets equal cash flow to creditors plus cash flow to stockholders. CFFA, which is cash flow from assets, is also known as free cash flow. The cash flow that goes to the creditors is the interest that they receive minus any new borrowing that you might get from them. So interest paid minus net new borrowing. Another way to calculate the cash flow to creditors is adding the interest paid to the long-term debt paid. Net new borrowing is the ending long-term debt minus the beginning long-term debt. The cash flow that goes to the stockholders is the dividend that they receive minus any new equity that they might raise to the company. So dividends paid minus net new equity raised. And the net new equity raised would be the difference between the ending common stock plus the paid-in surplus end minus beginning common stock plus paid-in surplus beginning. Everything will be found in the balance sheet. If the cash flow from assets is negative, it means that the firm needed an external source of funding, which could have been either from creditors or from the stockholders. It is clear now that the cash flow from assets is used to pay the creditors and the stockholders. When cash flow to creditors or stockholder is positive, it means money went to them, and so out of the firm. But from where does the cash flow from assets come? Well, the cash flow from assets equal to the operating cash flow minus net capital spending minus changes in net working capital. Let's define each term now. Operating cash flow is the cash flow coming from the firm's daily operations, including costs as well. In other words, it is equal to earnings before interest and tax minus tax plus depreciation, or just earnings before interest and tax plus depreciation if taxes are ignored. An increase in earnings before interest and tax, or an increase in depreciation, or a decrease in tax will increase the operating cash flow. Taxes are either given in dollar or as a percent rate. For example, if they say that the tax rate is 34%, then the tax becomes 34% times earnings before tax. In other words, average tax rate equals tax over earnings before tax. Thus, the operating cash flow becomes earnings before interest and tax minus tax rate times earnings before tax plus depreciation. Net capital spending is the cash that went into buying fixed assets. What you spent for buying them minus what you received from their sale plus depreciation of this equipment, or simply net fixed assets and minus net fixed assets beginning plus depreciation end. We already defined the net working capital as current assets minus current liabilities. Thus, the change in net working capital equals current assets end minus current liabilities end minus current assets beginning minus current liabilities beginning. As mentioned before, some of the revenues that the firm earns would be used to pay for the costs of production, expenses, and so on. Whatever is left will have the depreciation and later on the interest payments deducted from it, resulting in the earnings before taxes. Taxes are the percentage of the earning before tax that go to the government, and thus they decrease the net income and the operating cash flow. When taxes increase, these two values decrease and vice versa. Two important measures of tax are the average tax rate and the marginal tax rate. We mentioned that the average tax rate equals total taxes over earnings before tax. The marginal tax rate is the rate at which tax is incurred on an additional dollar of income. But what does that mean? Well, it means that the marginal tax rate is the value by which the taxes would increase if your income is incremented by an extra dollar. A firm's taxes are usually computed using this measure. It is important to note that these two measures don't need to relate to each other. One can be bigger or smaller than the other, and no pattern is found between them. Let's now try to solve some exercises related to taxes. For question number 1, we are given different ranges of earnings before taxes and different tax rates, and what is asked of us is to find the average tax rate for a firm with an earning before tax of $200,000. Average tax rate equals total taxes over earnings before taxes. We already know from the given that EBT equals 200,000. Thus, what we need now is to find the total taxes. In order to do that, we have to multiply each tax rate by the maximum EBT of its range minus the maximum EBT of the range before and add all the results. Nevertheless, we have to stop at the range of the given EBT, which is 200,000. So, taxes equal 0.35 times 40,000 plus 0.37 times 80,000 minus 40,000 plus 0.4 times 200,000 minus 80,000, which yields 76,800. Thus, the average tax rate equals 76,800 over 200,000, which is 38.4%. If earning before taxes increase by 50,000, then the new earning before tax will become 250,000. Taxes are equal to 0.35 times 40,000 plus 0.37 times 80,000 minus 40,000 plus 0.4 times 240,000 minus 80,000 plus 0.41 times 250,000 minus 240,000, which is 96,900. Thus, the additional tax is 96,900 minus 76,800, which is 20,100. Question number 1 gave us the following information. Sales to be 798,000, cost of goods sold to be 447,000, depreciation expense to be 37,000, tax to be 14,000, and an interest rate of 35%. What they're asking us to do is to find the net income for this firm. We all know that the net income is the earnings before tax minus tax. And we know that the tax is $14,000. So what we need to do is to find the earning before tax. We also know that the earning before tax is the earning before interest and tax minus interest paid. So let's first find earnings before interest and tax, which is sales minus cost of goods sold minus depreciation. So 798 thou minus 447 thou minus 37 thou to give 314 thou. Now, earnings before tax equals 314 thou minus 0.35 times 314, since the interest rate is 35%. Earnings before tax equals 204,100. Thus, net income equals 204,100 minus 14 thou, which is 190,100. Now, suppose that the firm mentioned in the previous slide kept $73,000 as retained earnings. How much money went into paying dividends? Well, we know that net income equals dividends paid plus addition to retained earnings. So dividends paid are net income minus addition to retained earnings. We know from before that the net income is 190,100 and the addition to retained earnings are 73,000. So 190,100 minus 73,000 equals 117,100. Note that if the exercise had said that the retained earnings decreased by 73,000, then the addition to retained earnings would have been minus $73,000 instead of $73,000. Question number 3 is asking us to find the amount of total liabilities. We know that total liabilities equals current liabilities plus long-term liabilities. And we also know from the given that long-term liabilities are equal to $4,180. Thus, what we need to find first are the current liabilities. We also know that since net working capital is equal to current assets minus current liabilities, then current liabilities are equal to current assets minus net working capital. And net working capital from the given is equal to $640. Thus, we need to find current assets. Current assets are equal to total assets minus fixed assets, which are $6,230 minus $3,910. Now, current assets are $2,320. So, current liabilities are $2,320 minus $640, and total liabilities are $1,680 plus $4,180. Question number 4 is asking us to find the amount of net working capital. We all know that net working capital is current assets minus current liabilities. We also know that current liabilities are all the liabilities that must be paid within the next 1 year. In this case, we can tell from the given that current liabilities are equal to 0.6 times 105,000, which is equal to 63,000. Since total assets are current assets plus fixed assets, then current assets are total assets minus fixed assets. Total assets are total liabilities plus total equities, which is equal to 105,000 plus 130,600. And fixed assets are given to be 165,200. Thus, current assets are 235,600 minus 165,200, which are 70,400. And net working capital, which is current assets minus current liabilities, are equal to 70,400 minus 63,000, which is 7,400. In question number 5, we are required to find the book value and the market value of total assets. Before we start with the book value, remember that total asset equals current assets plus fixed assets. And since net working capital equals current asset minus current liability, then current asset equals net working capital plus current liabilities. Book value is the balance sheet value. Thus, total assets equals 2,500,000 plus 725,000 plus 1,375,000. Market value is the value that the assets are worth today. So in this case, fixed assets would be 2 million, current assets would be 1,900,000, and market value would be 2 million plus 1,900,000, which is 3,900,000. This is it from finance for this week. But if you have reached the end of this video, it is because the content is helpful to you somehow. If this is the case, then please give your friends and acquaintances the opportunity to have access to these videos by liking, sharing, commenting, and subscribing to the channel. We will be continuing with more finance content next Friday, but before that, I will see you all on Monday with an introduction to the chain rule of derivatives. Thank you so much.